Welcome, everyone. We're ready to get started today. Thank you all very much for joining, and welcome to today's discussion on the evolving infrastructure of institutional crypto trading. I am David Eastoe, Head of FinTech Research at Coalition Greenwich, for which our coverage includes everything from trading systems to cloud to blockchain and crypto, and I'll be your host today. This topic is near and dear to my ongoing research on digital assets, so I'm very excited to hear from the experienced panel, and I'll be turning over to our Head of Research, Kevin Mcmartin, in just a moment. But just a couple of housekeeping items before we get started. Throughout the presentation, questions are very welcome. Please type them in the chat box, and we will try to answer them during the webinar, as well as at the end as time allows. And if you have any additional questions after the webinar, please contact us, as our contact information will be provided at the end of the presentation. And for any media present, if you would like to attribute a quote to anyone on this panel, please reach out to that individual after the webinar. But before we begin, for anyone that isn't familiar with Coalition Greenwich, market structure and technology, and our practice in particular, we are focused on capital markets, fintech, regulation, and how these topics impact market participants across asset classes, including digital assets. Our differentiator is in the data we amass as the basis for our analysis in order to provide our clients with confidence in our insights. And speaking of data, we have launched a brand new digital asset study, so please keep an eye out for the link to participate in the webinar chat later during the event. We'll make sure to bring that to your attention one more time as well. So the format today will be an open panel discussion, and I'm very happy to turn the discussion over to today's moderator and Head of Research, Kevin Mcmartin. Kevin?
Great, thank you so much, David. Thanks everybody for joining. So as David said, I'm Kevin Mcmartin. I'm the Head of Research for the market structure and technology practice here at Coalition Greenwich. There probably is not a hotter topic in market structure, institutional market structure, than everything crypto. It's a big area. There's been a lot of focus on this for the last few years, I think particularly over the last 12 months. We have a really fantastic panel of experts, and where we're going to focus today is really on understanding what that infrastructure is like. How do we support crypto trading in the institutional market? What are the things that institutional investors, institutional traders need, are looking for, are hoping for in order to get more involved in this market going forward? So with that, let's finally get ourselves started. So to start us off, for an introduction for everybody, I think it would be great. Tell us obviously sort of who you are, what you do, but then if you could tell us a little bit about how you found yourselves in these markets. Obviously, crypto markets are relatively new. You're all capital markets veterans, sort of from the traditional side. So if you could talk us through that evolution, we can then go from there. So maybe Vishal, why don't we start with you?
Yeah, sure. Started my career at Goldman Sachs. Actually, sorry, a little background. I'm head of exchange at Coinbase, where I help run the major market that we have here, liquidity, pricing, client connectivity, everything. So I found myself in crypto after spending a bunch of years at Goldman Sachs on the electronic trading desk, really kind of focused on listed options, order routing, some internalization mechanisms. Found myself at a market maker after by the name of Volant Trading, where I ran the execution desk. So again, order routing, payment for order flow businesses, again, retail against institutional. After I left kind of traditional finance, or what I guess internally we call finance 1.0, I took a hard left towards fintech before fintech really was called that. I was an early guy at a company by the name of Moneyline, which is a neo challenger bank here based in New York. Spent some time kind of evolving the business from like a pure lending to more of an investing and a proper neobank. From there, I really wanted to dip my toe into crypto. I had been trading crypto for a long time and wanted to kind of find out more and try to build a couple projects of my own, but ended up getting scooped up by Circle, where they had me lead their business development team and also a focus on liquidity. Really, my main focus was to launch and grow USDC, the stablecoin that's in consortium with both Circle and Coinbase, and also help out with their exchange, Poloniex. And now that's how I found myself to Coinbase, where I manage the exchange.
Cool, thanks. And Vishal, also an RPI grad like myself. We have to plug RPI. Good to see you here. Chris, why don't you pick us up from there?
Sure. Thanks for having me. My name is Chris Zulke. I am the global head of Cumberland, which is the crypto asset business specifically focused on OTC liquidity providing of the larger proprietary trading firm DRW, where I'm a partner. I've been at DRW for about 17 years now. I actually got my start by being the founding engineer for the firm's first algorithmic trading desk way back in like 2004, when the derivative markets were first moving from the pits up to the screens. And kind of a long path, 17 years at a single organization. I did a lot of things, but at the core, I was really involved in the development of new markets and the evolution of markets from traditional to electronic. So as crypto started and as the firm got involved in 2014, we're not only looking for ways to provide liquidity in the OTC space, but also lend our expertise in the market development and institutionalization of new ideas in trading and finance, take that knowledge and apply it to crypto. And as we kind of thought about how the business was evolving over time, it kind of made sense for me to take some of the skills that I built moving from pits to the screen to apply them to the crypto market, which basically was going from nothing to something in a very short period of time. So I kind of went down the rabbit hole a bit, more from a market design perspective than a individual asset perspective in crypto. And I've kind of been stuck there ever since, stuck in the most positive sense possible. I spend a lot of my time these days now thinking about how the market is evolving, what pieces need to be built in order for us to hit that next generation of adoption and the next phase of evolution and sophistication. That's kind of what I'm doing today as we talk about those topics on this panel.
Great, Chris, excited to have you here. Last but certainly not least, Travis.
I'm bummed I'm not a Red Hawk. Is that the mascot of RPI? The Red Hawks? Is that?
Yeah, it's really the engineers. They keep changing it.
Oh, very interesting. Bummed I'm not part of that. Well, thank you, Kevin. Hello, Travis Schwab. I'm the CEO of Eventus Systems. Eventus is a trade surveillance reg tech company that provides fin risk solutions, trade surveillance, transaction monitoring, market risk to markets around the world. So brokers, proprietary trading firms, exchanges, regulators, and the like. Intro to crypto was probably in 2011 when I was at a proprietary trading firm. Some of the smart engineers said, hey, we should probably be using some of these machines to mine coins. Unfortunately, we did not jump into that at the time, but that would have been a better idea. Eventus got into this space in about 3.5 years ago. An exchange came to us that was looking for be able to leverage our experience on the traditional markets to help them with their trade surveillance program. And so we worked with them. They were very early adopter and a great partner of ours, and we've expanded that now to about a dozen exchanges around the world that use us for trade surveillance on a daily basis.
Great, thanks. So let's talk about institutional markets and crypto. And obviously there's interest from investors, there's interest from a trading perspective, but what drives the interest for institutions? Maybe we'll start with you, Chris. Is it volatility? Is it the non-correlation to other assets? Like why are investors and traders both thinking this is an interesting space to get involved in?
Well, I can't speak for retail traders. We only really work with the institutional side, yeah. But what I can say from them is anything that's new, anything that could be transformative for a marketplace inherently is going to attract the most thoughtful investors and the most thoughtful traders. Partially it's because of the volatility that might exist in a new asset class, but partially it could be because of the ramifications a new asset class can have on the existing financial markets. I think one of the things that we talk a lot about, at least recently, is Bitcoin a relevant and reasonable store of value compared to gold? And if you have that conversation, you're inherently going to start talking about whether or not Bitcoin should be in a portfolio that's looking to potentially hedge macro risks. On the other side of it, and this is a more recent conversation, is the idea that evolution and innovation in the crypto space beyond individual assets can have a significant impact on financial markets. And the most meaningful one currently is the DeFi space. And what does decentralization at scale mean for traditional markets, particularly when traditional markets have been driven from a centralized model, intermediated model for many, many different years. And I think a lot of folks that are in traditional markets are trying to wrap their heads around what that means and what opportunities might arise as a result of it.
Yeah, interesting, right? So it still continues to be both about the asset, if you will, and the technology that powers it, and really what impact can that have on the markets as a whole?
Yeah, I think that's a great way to put it. I think sometimes people get caught up on what is the price of Bitcoin or what is the price of ETH at any given point in time. But what we're seeing a lot more from the institutional folks isn't so much a what is the price today, but what is the market going to be a year from now? And
Sure.
What needs to happen between now and a year from now or 2 years from now in order to realize those goals. So oftentimes that's more about the technology and the operations that are being built as opposed to like the trading opportunity that might exist today.
Mm-hmm. So yeah, Vishal, so when you talk with institutional customers or prospects as you build out the exchange business, what comes up? What are they thinking about? What do they need? What drives their interest?
Yeah, I think that, obviously on the institutional side, there's a bunch of different categories here. You have investment firms, corporates, banks, and wealth managers really looking at this area. One of my key focuses is obviously market makers because of our large liquidity pool, our active retail taking flow, and we talk to a lot of the teams that come out of traditional finance, and they're looking to make markets in a market that has a lower bar of entry. A lot of these markets like equity, U.S. equity options, futures, to become a market maker, the bar is so high. But we've seen these institutions, we've seen these market makers, we've seen these stat arb firms, start up with 1 or 2 people out of a garage somewhere that are really interested in trading these active markets and being on the other side of order flow. And I think that that's really interesting about crypto, and really our focus is to make sure we keep the bar as low as possible to invite as much liquidity as possible, to make sure that there is a large deep pool of liquidity available to again, retail order flow, but also the natural takers on the institutional side.
Travis, what else can you add from your perspective?
Yeah, for us, it's been I'm actually curious more on the question, so I'll talk about in general, but for us, our clients really are on the sell side. And so there's been a huge interest for them traditionally on the sell side over the last 12 months to figure out how to bring this asset class into their existing infrastructure. And so for us, we don't get a ton of visibility out as far as are they pensions and endowments and more the traditional investors in that space. But we are seeing then their service providers, the prime brokers and things like that, firms like that, really investigating this space to see if they can do it from a structural standpoint, from a technology standpoint, from regulatory standpoint. And so there's clearly a lot of investigation. There's a lot of interest. There's a lot of concern about, do they have the infrastructure? Can they handle it correctly? So we're really, that's been a swell over the last 12 months.
Well, maybe good, Travis, if I can build on that. So how should we think about the infrastructure compared to traditional markets, right? So if we're thinking in traditional capital markets, exchanges, broker dealers, market makers, prime brokers, does that infrastructure exist yet in crypto? Will it exist? Should it exist? And where are we in that evolution?
Well, I mean, the panelists my fellow panelists here are great examples of core pieces of that infrastructure. And so you've had firms, really leading firms like Coinbase and Cumberland for years now in this space, building up pieces of this infrastructure that, whether they mirror the traditional finance or they're enhanced versions, or they're what is necessary to help investors fill the gaps. And so I think across the board, whether you look from the order generation or the idea generation, all the way through that life cycle trading activity and clearing and custody and financing, there are now pieces, at least examples and good companies in each of those areas, each of those buckets. And so in general, I think the infrastructure is still very much in its infancy, but there's a lot of very seasoned, relatively speaking, seasoned companies in this space now that are providing institutional grade capabilities like Cumberland and Coinbase. And so for us, we've been in the space, 3-4 years now. There's a lot of what we've learned in the crypto space. We also married with what we were seeing in the traditional space. I don't think there's a lot of unique capability or unique aspects of parts of this ecosystem around trading. There's huge volumes. There's interesting, volatility spikes. Some of the AML, KYC aspects can be, a little deeper dives. But in general, I'm not saying we've seen this movie before, but pretty close. And so we can pull a lot of analogs over from the traditional space and at least start that process. And a lot of those pieces are established and continue to get some traction underneath them.
Cool. Yeah, and Chris, why don't you jump in? Sure.
Yeah, actually, the seen this movie comment kind of rings a little true here. What I've noticed, kind of comparing what we do with Cumberland to the history that DRW has in financial markets, and kind of my own personal experience is when I was working to build the algorithmic operation in traditional assets back in 2004, 5, 6. You did not have to think about certain problems. There were commoditized utilities out there that kind of solved the problem for you. The most common one being the PB or the FCM for purposes of clearing and access to capital. It was this utility that existed. You had to have your negotiations with those banks in order to get the funding and the rates and whatnot, but like that was it. Like you had the conversations, you signed the docs, you moved on. And as a result, we focus a lot on technology, on intelligent and performant trading systems, on smarter trading strategies, risk management. And what I found is the crypto market started to grow. A lot of those utilities that you kind of took for granted in traditional markets just did not exist. So the skill set you needed to hire for, the technology and the operations that you needed to build weren't just about the trading strategy and risk management. It was about building those utilities that did not exist for your own purposes until the market can offer you a solution that fits your need. Now, over the course of the past few years, we've been able to really rely on some of those centralized utilities that have been built up in order for us to focus on what we are good at, which is risk taking and liquidity providing. And as a result, that's our goal now. We focus there and we work with the rest of the industry to leverage those utilities that they're built up over time. Now, where some of our experience does fall short is where there's totally novel problems that need to be solved as the market becomes more institutionalized. The most common one that I raise is on-chain analytics for AML and KYC purposes. That this concept of following coins through the blockchain does not exist in traditional finance. So you can't really take what you did in Eurodollar futures and apply it to Bitcoin. You kind of have to view it from a totally new perspective and supplement those traditional market skill sets with totally new capabilities and totally new systems. But I think the good news is that the market is figuring those out, and they work with firms like ours and Coinbase and everyone else for that matter to dial in those technologies to meet the needs and to kind of reach the bar necessary to satisfy the regulatory and legal requirements along the way.
Yeah, I can jump in, Kev. So traditional finance, had decades, and I apologize. In New York City, you're going to hear sirens. In traditional finance, they had decades to evolve into the market structure that we see here today. Crypto, we're seeing is a very quick evolution of our market structure happening in years and sometimes months. It's hard to take a breather here because you're going to miss something in the market. Crypto grew up as like kind of one thing: brokerage, the exchange, custody services, all kind of like clumped together as one thing. That's how it started off. And we see a natural evolution where some of these pieces are being pulled apart. And you're seeing brokerage services both on the institutional and the retail side. You're seeing like liquidity services or like an exchange kind of separating out. You have custody services, you have lending, all that stuff kind of like is starting to become its own businesses. With the acquisition of Tagomi, you see us moving towards prime brokerage services on one side. So again, that's like that's client-focused, liquidity agnostic, and it includes like leverage and custody and all the other great services out there. And then on the exchange side, we become liquidity-focused and client agnostic. We want to be like broker agnostic. We want all the brokers in the world to look at Coinbase Exchange and say, well, there's only so much liquidity out there. There's only so much Bitcoin you can put on order books, and we need to tap that liquidity source. So that's our job.
And so
yeah, Kevin,
it's interesting.
Kevin, if I could just jump in there, I'm sorry. I wanted to ask Vishal and Chris, if you like on a continuum of market structure, let's say 1 being, very early on, 10 being very traditional, where U.S. equities are, kind of, Chris, where do you think the crypto infrastructure is, like on that continuum from a scaling standpoint?
It's a great question. Typically, it's kind of asked to me in the sense of like, what inning of baseball are we in? And yeah, I think we're in the first to second inning, to be frank. I think part of that reason is that the specialization that Vishal is mentioning and that I'm mentioning is still emerging, and people are starting to really kind of like plant their flags around that specialization as opposed to the generalist model. But I think we're also we're still watching the evolving landscape of regulation. And I think it's really difficult for anyone to look at the crypto market and say we're in inning 8 or inning 9 or even in inning 5, while some of the regulatory clarity or specifics are being established. And while we wait for that commentary, some of which is supposedly supposed to come by the end of July, Senator Warren requested some commentary from the SEC recently. I think while we're still waiting to see that and get the indications as to how the regulatory landscape might change, we're going to be in those early innings. But I think people are using the time that exists now to continue to build what we think is necessary based on the education we have from previous markets. So we're not quite in like the first pitch of the first inning anymore, but we're certainly not we're not halfway through the ball game by any means.
Yeah, I totally agree with Chris on this. We still haven't seen proper regulated derivatives volumes really trading yet in the U.S. We haven't seen any price protection mechanisms like Reg NMS or anything like that come in. Lending and staking is still kind of unfolding, and we're trying to see what that market looks like. DeFi is evolving as we speak, and we're all trying to figure out what it all looks like. And I do think we're really early here still.
Do you think it's going to be difficult for so many traditional capital markets folks who, as Chris pointed out, right, you expect these certain things are in place and you just pick them and you sign the docs and you move on? Is it going to be difficult to not end up cutting and pasting rather than throwing it all out and saying, how do we build this the right way, right? Because in some of those traditional markets, equities, futures, there's literally rules that are 100 years old, and technology that's probably 40 years old that it's hard to just throw out. So is this the opportunity to really figure out how to run a market better?
I think that, sorry for jumping in, I think that, not just the crypto market, but all markets are going to be, we're going to take a fresh look at everything. You look at clearing functions and equity, you look at a bunch of the OCC, you look at a lot of these functionalities that have been around for a long time, and then you look at blockchain and you start to ask yourself, well, why do we do things the way that we do? And I think that you're getting a lot of smart people that are hyper-focused in this market structure that know traditional markets and are starting to ask those questions and can kind of start pushing, the SEC, FINRA, everybody forward. And I do think that this can be an exciting time, not just for crypto, but for traditional financial markets. And honestly, I think there's gonna be a blurring of the line over time.
Yeah, and just to kind of build on that, I think there's a lot of lessons to be learned from traditional markets. And I think a lot of those lessons are already permeating their way into the crypto space. But there's also a lot of innovation to come from the sandbox that is crypto that could be applied into traditional markets as well. The way I've kind of described crypto and why it's so fascinating to me is I've spent so much time in the traditional finance space that you learn very quickly this ethos of first do no harm. I spent a lot of time in 2008 and 2009 working around the regulations that were emerging from Dodd-Frank and swap dealer rules, and the amount of deliberation that went into like one line of a rule in a 1,000-page legislation kind of thing. I've also spent a lot of time working with regulators to provide some, at least, opinions regarding something called Reg AT that was proposed by the CFTC, which is something that was built to add some recognition of new technologies and new trading strategies to the rule set that exists at the CFTC level. And that was also a methodical process of let's learn, let's apply the knowledge, let's suggest the rules, let's work with the industry to find the right middle ground. And then you go and you look at crypto, and it's kind of got this let's innovate, let's figure out what's wrong, and let's solve the problem in a better way mentality. And to take those two approaches and push them into a single market environment together has really led to a fascinating dynamic of let's take those lessons that we learned since like the 1850s when livestock markets went live and apply them to this totally new technology. So we don't run a lending business, but there's a reason why lenders in the crypto space require collateral, right? And it's just smart economics. But at the same time, something like DeFi or something like just digital assets in general bring totally new technologies that I think traditional markets have not previously considered, but are all of a sudden thinking about, well, how can you apply a distributed ledger to our clearing model? How can you apply decentralization of financial assets to risk management? Like it's a super fascinating world of take a little, give a little that we're still waiting to see how it all shakes out.
Yeah, it's incredible, the Dodd-Frank comparison, right? How much more technology we have 10 years later from back then when auto quoting swap prices seemed like a huge deal, right, to do that in real time. And even that market transformation, again, seemed so big at the time, but really it was an existing product that was being worked into existing ideas and existing technology. This is a new product being brought to market with new technology, a whole new world. So Travis, I'm going to bring it back to you. So there definitely is still reluctance by some market participants. I said, you work mostly with the sell side, but there's definitely still some nervousness from a lot of folks, investors, sell side firms, right? There's regulatory uncertainty. There's, it's a volatile market. So what are some of the things that are being done now to think about how markets should be made safe for institutions to get more people comfortable with the infrastructure and coming into the market?
Yeah, 2,300 pages, Chris, Dodd-Frank, 2,300 pages.
All right, I'm only an expert in Title IX. I apologize.
No, but I think the actual the analogs to that time or the callback to that time is really informative now. Is you have the same person at the SEC that's in charge that was responsible really for a big part of Dodd-Frank. So I think there's a lot to learn there. So Kevin, to directly address your question, and Chris touched upon kind of the on-chain analytics earlier, is there are, again, in every part of the life chain of these transactions, there needs to be adoption of these techs. And one of those, where we're trying to position ourselves with some of the on-chain analytics is that path where you're bringing on clients to know your customer, know your coin, how you're then dealing with deposits and withdrawals. Once you're on exchange, how you're dealing with transactions there from a trade surveillance standpoint. Every exchange, crypto exchange that wants to attract institutional investors has to adopt technologies like these to be able to attract that. You have to make these institutions feel comfortable that you are applying the same rigor, the same robust written supervisory procedures, testing infrastructures to make sure those procedures are working, and the relevant technologies to enable that. And so there's, and what's paradoxical or very interesting about the crypto space is there has never been an asset class that has more transparency relatively built into it compared to traditional finance, yet there's a real reluctance or a real concern on the institutional investor side. And so I think there is a real opportunity with some of these tools that exist today that these various constituents of the ecosystem are adopting that should allow institutions to feel very, very comfortable with the infrastructure that's being developed. And it's still emerging, and you have to, we talked about linking a lot of these systems together, but there's a lot of great vendors in the space that are developing good tech in there. So we see more innovation there daily, pretty close to daily.
President company excluded, Travis, or you want to pitch your own book a little bit too?
Sorry, what, Chris?
So present company excluded, or you like? I mean, I'll pitch Travis's book. Like, I mean, they're doing cool stuff in the space, and while he's being careful not to sell himself too much, I think folks like Eventus and Travis are helping to solve that problem.
Very nice of you. Thank you, Chris.
Yeah.
Thank you, Michelle.
For sure. And so it makes me think, right? So like I would say that, Coinbase is a great example of public company, easy to use app, made the crypto market feel really accessible and safe for retail investors, at least to start. Is there a one-for-one comparison for something like that then makes institutional investors and traders very quickly feel like, yep, this is easy and accessible?
Yeah, I think that, like, if you look at the last bull market back in like 2017, that was really retail driven, and what you're looking at in the most recent run up was institutional driven. And a lot of the tools that they ask for and they look for are like, do I get drop copies back? Am I order routing? These are all things that are very traditional finance, and there's a muscle memory here. And if you look at a lot of these companies that look and feel like Coinbase, you're getting a lot of traditional markets people that understand what a fixed drop copy looks like, and what what market data should be formatted like, and everything. So I do think we're starting to see that natural evolution where this is a product class, and I don't think this is just like crypto becoming finance 1.0. I actually think that it's crypto kind of taking over the world, and you're going to start asking yourselves, like, why do I have to do T+2 clearing for equities, or why am I winning? There's a lot of questions, like, recently, not to play our own book more, but like, we lowered the fees for stable pairs. So essentially dollar to euro, like, let's get the fees down to almost nothing and introduce more FX trading on our exchange. And we're starting to see that ramp up. We're starting to see traditional finance firms, institutional firms starting to ask those questions of, like, why don't I just trade this in a crypto format? And I think that's the evolution that's really making me excited for the future.
I mean, I'll to the point of T+3 to T+2, I'd be pretty interested to see how the industry reacts to go to T+2 to T0, right? I mean, I was tangentially associated or involved with some of that work, and I mean, that was a big lift for the equities industry to go from T3 to T2. But I think to kind of further on Vishal's point, what we've seen is there's an interest in accessing crypto in contract types that are comfortable to institutions. What I mean by that are those types of contracts that they've transacted before, those types of contracts that have clear regulatory oversight, that their back office and operational systems understand and speak right now, and naturally those are like listed derivatives. That's the easiest place to start. The CME has the CME future on BTC and ETH. Those fit all existing clearing models. They fit all existing operational reconciliation models. They fit into most trading systems. So I think there's the bit of the walk before you run mentality. First, start with contract types that you understand. Maybe after futures, you go into something like a synthetic product like a NDF, and then you kind of build yourself up from there. And I think that's not just a natural set of steps to take in crypto, that's the natural set of steps to take in any developing market. First, start with vanilla type contracts, and then get into some of the more exotic stuff or more nouveau elements that might exist that represent opportunity.
I mean, and Chris, sorry, go ahead, Travis.
No, I just there's always this kind of, oh, crypto hasn't gotten there yet and we're very early. We have feet in both the traditional side and the digital side. There is a huge chunk of the traditional side that hasn't gotten there yet either, by the way. This is not like a solved problem. Vishal talked about fixed drop copies, and we've talked about some of the pieces, but still across major established asset classes, the infrastructure is a mess, continues to be a mess. And you even have these monster asset classes, fixed income, FX, that are still not from a market structure and data infrastructure, not in a really smooth operating spot. I mean, there's obviously great core pieces of the infrastructure, but the data challenge along all of those asset classes is still very challenging. And so I like to think, at least people are like, oh, well, it doesn't work like FX or it doesn't work like equities. Part of that is not a bad thing. It's nice to actually try to find more modern solutions to some of the problems that still plague big chunks of the industry.
The tremendous point, Travis. Yeah, I mean, we did some research just a few months ago on leveraged loans, right? Average settlement times are 15 business days.
Right.
And less than 2% of the market trades electronically, right? Hopeful to grow, and one solution for that is certainly distributed ledger, right? But yeah, you're absolutely right. And to Chris's point, I think that's an interesting evolution of how you can step in as an institution, right? Even in established markets like oil, likely you will buy a future before you go buy a tanker, right? You have to sort of get to know the market from easier to access products.
Now, what's fascinating about that, and I'm just going to put my foot in my mouth because I just said walk before you run, but there's also like the paradigm shift component as a result of this like transitional technology. And I think smart contracts are a fascinating concept and will let people do things that just historically have been unable to do in efficient manners. So you talk about leverage loans, you talk about anything that has a kind of a structured kind of vanilla aspect to the execution of the contract that traditionally has been very operationally intensive. Like, I don't anticipate a world in which there's a walk before you run element. I anticipate a world for those kind of more unique, complex operational components for someone just to eventually say, why can't we put this in a smart contract? And like make that leap all the way to the end game there. I think there's a lot of work to be done before you get there, but there's a lot of smart people looking for ways to apply things like smart contracts to solve those sorts of problems.
And Vishal, are those the kind of things you spend your day thinking about as you're sort of building out this sort of new version of an exchange?
Yeah, I mean, I think that we're constantly, well, number one, Coinbase is crypto native, and all these evolutions are things that we're hyper focused on. And without showing everyone my book, I'd say that smart contracts are not only novel and interesting, it's really how I always say USDC was the gateway for DeFi. You really couldn't trust lending or trading in a DeFi manner until you had a dollar you could really trust that was ERC20. And a lot of the work that we had done initially, my past job at Circle and also my current job at Coinbase was, making sure that you could take a dollar and as quickly and as frictionlessly as possible in both like fees and time, make it into a crypto native dollar that you can push and pull within some of these DeFi protocols. And I think that the work that was done for USDC specifically really helped kind of evolve that market. And I remember when DeFi was called Open Finance, they're still trying to brand the thing, and we had Compound and Aave, and everybody's like, well, this is what we're trying to do, and we're just trying to figure out how to take this physical dollar, put it into an Ethereum wallet as quickly as possible, and that was our key metric.
Well, and that's exactly why the Treasury Secretary, right, is focused on understanding stablecoins, because to your point, they're such an integral part of sort of making this market accessible to big institutions. So we have a couple of audience questions, and they're great questions. So thanks for those that submitted. I like this one. So what does the tech stack look like for institutions entering crypto markets? Seems to be a lot of vendors focusing on front office execution, trade handling, and back office custody. What do you see in the areas around portfolio management, risk management, et cetera? And I'll sort of put that to the panel, anybody who wants to jump in.
I could hop in. I mean, at our core, what we do is liquidity providing and risk management. Like, if people ask me what DRW does, I say we're risk managers. So we've kind of focused on that. We spend a lot of time not only building our own risk systems, and I'll call them portfolio management systems, but also looking at what's being built in the space. And a lot of what I see is more of updating existing systems to integrate with blockchain technology and crypto assets than kind of start from scratch greenfield build specifically in the crypto space. And the reason why I think that's the case is risk management principles, regardless of the market that you're thinking about, are common. You're just working in different orders of magnitude of the types of aspects of the market that you need to think about from a risk perspective. We were joking a little bit earlier on the desk. We were talking to someone that was, saying that their market was trading at like a 38 vol today, and we kind of laughed. We said, okay, that 38 vol, no big deal. Like we trade at 150 vol, and
just
as a result,
say, bring 38 vol. Let's do that all day. The institutions would love that.
Yeah, I mean, that's a big thing for most traditional markets. But the way we think about risk and the way they think about risk is very much the same. It's just the order of magnitude and the way that we think about tail events and those sorts of things is just up a few levels. So I think the reason why firms like ours have been able to move into the space at the pace that we have is because we have that pedigree in those systems to just adapt to this new asset class. And I think that's what you're going to continue to see over time is rather than institutions looking for ways to create a totally new risk system, they're going to look for ways to integrate crypto into their existing risk systems because there's too much institutional knowledge baked into those things to kind of just walk away from. Now, that doesn't address crypto specific risks. I mean, there's things like 51% attacks you got to be aware of. There's things like double spend issues that are kind of totally orthogonal to traditional finance. But that takes a different approach to market understanding and mentality than traditional portfolio management would.
And then, so the other thing that this all makes me think is there enough data available for traders, investors in crypto space as well? To Travis's point earlier, on one hand, it's incredibly transparent, but then on the other hand, the traditional sources of, we keep using U.S. equity markets, right? But you can get you can pay and get a record of every single trade done, within a couple of hours. So is there enough data available, and if not, or even if so, what needs to be done to advance that?
I could probably field that one at least. Yeah, I mean, our goal is to be as transparent as possible as an exchange here. We're obviously an entirely lit market, and we produce market data that people can see. You can see our liquidity. You can see, we publish liquidity reports on a quarterly basis. I think that even like things like fee structures, things like that, like if people don't believe that they're transparent and that that they hold water, then people will start to back away from some of these markets. So that's our goal, is to make them as transparent as possible. And I think that you'll see over time, again, with prime broker businesses kind of spinning up, and you'll start to see liquidity centers getting bigger, and the smaller ones will probably just like have to kind of fight for the scraps for a little bit. The goal of like an exchange like ours is to be transparent, to offer all the data necessary to trade the market and to be a fair market.
Yeah, I'd almost argue that the data and the crypto side is a much more pleasant field to play in than the, let's say, U.S. equity side, which is a really challenging place to play in. And the fact that you have regulatory mandates part of the data space, whether that's Reg NMS data or the CAT, pick your version there, and then on top of it, fees and the amount of fees, and it's really a profit center or a business line for a lot of industry players in the space. And so the cost of moving into, let's say if you were, Chris talked about kind of moving into a new asset class early on, a couple guys, or Rochelle did, a couple guys can start trading cryptos only because the data is very reasonable. You can go out and acquire these data sets, the drop copies, and you can start a business very reasonably. If you try to do that in the U.S. equity space, you're looking at tens of millions of dollars potentially in trading infrastructure to be able to play on a level playing field. And so there's a lot of data. It's readily available. There's a lot of smart vendors in that space doing aggregation and the like. And so in general, I would say that the data space, market data space, at least within the crypto space, is really a better spot and a more rational spot to play in than a lot of these traditional asset classes.
I just want to chime in here too. Partially, I think I have a joke or two to make, but I think there's also some real information there. There's no such thing as enough data. Like, and if you listen to my researchers on Cumberland, like, we have nowhere near enough data. But I will tell you right now, it's the same exact thing that the researchers that I worked with in fixed income and energies and equities said. Like, any researcher that tells you they have all the data they want and they're perfectly happy is frankly probably not doing their job right. Now, what's interesting is in the crypto space, I think what Travis and Vishal referred to is true. Like, there's this preponderance of information that previously has not existed in traditional finance. I think there's still gaps though, right? And one of the gaps that we commonly point at is the difference between on-chain transactions and off-chain transactions, or omnibus account transactions, which is typically the model that most exchanges use because it's not really practical to do on-chain transactions for every central limit order book trade. And trying to balance the difference between what you see on-chain that is not necessarily publicly attributable to any individual action. So you kind of have to decide what you see on chain and what's the purpose of it, and compare that to the off-chain central limit order book trades. That there's an interesting dynamic there that you need to spend some real time understanding how to apply your thinking to both of those data sets. And they both have an immense amount of information in them. It's just, it represents a problem that I think traditional finance hasn't had to solve in the past.
And Travis, to you, like on the surveillance side specifically, surveillance is all about access to data and information. So are some of these dynamics, I suspect it creates unique challenges for you guys as you're trying to help folks keep an eye on what's going on.
Yeah, it really does. And Chris nailed it as far as what is the challenge driving really where we're spending a lot of time innovating in our product roadmap and our vendor partnerships as well, is how do we give a complete picture of activity, because it's hard. It is very difficult. We've done great, we continue to do great work off chain and on kind of the exchange trading side. And there's a ton of data analytics, on chain firms out there that have done a lot of infrastructure. And there's newer vendors that are doing kind of the travel rule compliance and withdrawals and AML type activities, but blending those worlds together to get a complete picture is still something that needs some investment and some work. And so we continue to work with a lot of our partners, like the folks here, to try to give them a complete picture, because it is. But even then, again, I would go back to that complete picture doesn't even come close to exist in the traditional asset classes. And so we're doing way more than what exists within the traditional asset classes, because you can. And this crypto has, and plus people are trying to give the regulators as much comfort and investors as much comfort as they can. So it is an interesting idea, is we're going well beyond what exists in the traditional asset classes in a lot of cases for these types of problems. I don't know if you agree with that, Chris or Vishal.
Yeah, I mean, like, if you look at one of the on-chain analytics solutions, you could understand the provenance of a coin going back dozens of wallets. You can't do that for a dollar, right? Like, it's just a fundamentally new capability that exists as a result of on-chain immutable transactions, and I think that's a market improvement to traditional finance.
Yeah, I think that there's a deep pool of data here, and I think that if anything, institutions might look at this as say, there's a lot going on here, and they need teams like us to kind of help sort through the mess and really kind of show what's important and what's not. And I think that that's part of the reason why, I'm really excited about the institutional uptake of crypto focus here. I mean, if you look at any of these firms that you're talking to, a lot of traditional finance people have come here because there's so much innovation. There's so much, there's so much to do. Whereas in traditional finance, we were just trying to trade faster and faster and faster.
Yeah, and so one of the audience questions on the data front was about the importance of standardization in institutional markets of data. And Vishal, I assume you're one of the bigger creators of data. Any thoughts on how you see that evolving and developing over time, that idea of data standardization for crypto?
Yeah, I think that people want people want clarity of the data, and like I said before, we're trying to be broker agnostic on the exchange side. Like, we want like the DRWs of the world to also trade on Coinbase, and we want everybody else to take liquidity and provide liquidity on our exchanges. And I think that it's really important for us to be friendly for all types of institutions and retail clients, and that you need some uniformity to make that happen. If we all have a different widget to adapt to, then nobody will code to. So we want to be as careful about that as possible.
Great. And so one more audience question, and then we'll go to the typical where do you see things going to take us out. But so this one directed specifically at Chris, although I suspect that Travis and Vishal could also have an answer. But who can likely fill in the space of FCMs and custodians, or will the needs be serviced by new participants in the marketplace? So yeah, so will the traditional FCMs play that role, or do you feel like it'll be new entrants altogether playing that role?
Yeah, so I'll answer this for Vishal real quick. I think Coinbase wants to do that, and I think they're doing a lot to try to accomplish that. And it would be silly for me not to acknowledge it. And so, like, let's level set, and I'm sure he'll speak up about that. But there's certainly new participants in that space that are doing some good stuff to try to fill that role. That said, there's also the traditional market participants. The folks that are clearing CME futures are the traditional FCMs. It follows traditional clearing models. It goes through the FCM up to the CME CCP. It has margin rules established. It kind of flows pretty seamlessly. So what you're really seeing is the market figuring out what is the right entity for each aspect of the clearing model, on the spot side and on the future side, on the funding side and like kind of the prime side, how you handle access to finance, and I think access funding. I think what you're going to see is some of the old players continuing to grow, but I also think you're going to see some of the new players continue to grow and potentially take maybe not existing market share, but certainly establishing a material market share in the kind of the crypto nouveau space.
Yeah, I no comment on the Coinbase comment, number one. As a trader, I know that, I come from the vol side of things. I come from U.S. equity options, and I know those markets were traditionally built for retail and consumers, and to write insurance contracts on their equity. And to this day, it's still really hard to do, to trade vol in crypto markets. And as a trader, I'd love to be able to do that better, sell some premium and buy some YOLO calls and all that other stuff that people are doing with these meme stocks. And why not do this in our crypto world? I think it'll take time, but I'm really excited about where that's going.
That's great. Yeah, so for everybody in the audience, we put a link in the chat for the new study that we are just starting. So would love everybody's input on that. So please take a few minutes to do that. So just to wrap us up, and I was going to try to keep us to 45 minutes, but there was just way too much good to talk about. Can we leave it all with you both? If you could talk about just quickly, sort of what do you think are some of the biggest new innovations you're seeing now? Maybe things we haven't heard of, and then 3 years from now. Crypto institutional markets, where do you think we are? I don't know, Chris, why don't we start with you?
Oh man, that's a lot of pressure. I think what we're going to see is two paths of progress. I think the first is very much going to be the adoption of crypto assets into the traditional financial infrastructure. You're going to see this by organizations, large organizations, those that have a lot of history deploying into listed derivatives, OTC bilateral synthetics, and then eventually as the markets continue to develop, you'll probably see a growth in the option space, you'll see a growth in the fund space, potentially eventually we might see an ETF in the United States eventually. I think you're just going to continue to see the adoption of crypto by traditional markets in one vector. And then on the other side of it, I think you're going to see the industry, and when I say the industry, I mean financial industry in general, cherry picking innovations from crypto and leveraging them to do totally new things. And what I typically point at is DeFi in this space. Like I don't think you can ignore the ramifications of disintermediation at scale and what that can mean for innovation in the space. Now, it's not going to happen overnight. I've heard people talk about this idea of DeFi for equities in the United States. And my first reaction is, well, how in the world are you going to satisfy Reg NMS and Best X when you're working in a DeFi space? Like I've spent a ton of time thinking about that and I'm baffled. But beyond that, you also have things like AML and KYC that is an important aspect of the DeFi space. So you have platforms like Aave, Sushi, and the like starting to think about what it means to have like institutional pools. So I think what's happening is you have that base innovation, and now people are trying to think about how to actually turn that base innovation into something that can grow. So I think that'll be the second path that you'll see of this market as it develops over the course of the next 3 years.
Cool. Thanks,
I can build on that a little. I can build on that a little bit. So I think Chris is right. I think you're going to start seeing a lot more blurred lines. And again, we playfully call traditional finance fintech finance 1.0. I do think we're seeing a natural evolution to the next version of finance, and I don't think it's just the crypto market that will learn from this and evolve from this. I think you're going to see traditional markets picking up pieces of crypto here and there, and I'm really excited for it. We have a front row seat to a lot of this stuff, the teams here, and it's some of the teams and the projects that we see are just working on things that are going to change the way we think about finance and dollars and equity and tokenization. So I do think that there's going to be that push towards like tokenization of everything over time as well. We've seen a couple starts and stops on this. Why don't we see a proper gold token? Why isn't real estate properly tokenized? Those are all things that we're all trying to answer, and I think that you're going to start seeing the evolution of that. And because of that evolution, DeFi and traditional crypto markets will become more and more important, and they may also just kind of like fade into the background. We're just kind of things just kind of happen. You have atomic swaps everywhere, and people just trust them, and they work. So I think I think again, like it's all magic until it's just something we just all believe in.
Travis, why don't you take us out?
Yeah, so I think I would echo some sentiments there. I would caution that it always takes a lot longer than everyone thinks. And also, centralization has happened and intermediation has happened for reasons. And so just to try to disintermediate or decentralize things just because probably doesn't make sense all the time. And there are a lot of market structures that exist that are really, really efficient that probably don't need a ton of innovation. I would also say that regulators don't work very quickly in general. And so if we're looking out 3 years, there still might be a ton of regulatory uncertainty, which will be a natural dampening on all of these, very interesting innovations. And so I think that, Chris talked about that push-pull that continues to happen. I don't see us coming out from under that anytime soon. So I'm not bearish, but I just think the blocking and tackling always takes longer than you expect it to. These are challenging problems. People's money is at stake, and so people want to be very cautious in certain ways to make sure that they're doing things in a thoughtful and moderate way. So very exciting space, but it never moves as fast as you think it should.
No, sadly not. Well, guys, thank you so much for taking the time. Awesome conversation. I learned a lot. I hope everybody else did, and maybe we'll get back together in a year and see if it all comes true. But thanks so much again. Have a good rest of the day. Thanks for taking the time.
Thanks, Kevin.
Thanks, folks.
Appreciate it.
All right. Thank you.
Take care. Bye-bye.